Okay, good day. We are proceeding our series on process costing, and we've been looking at the process losses, and today we are going to look at the abnormal losses. Abnormal losses, as the word suggests, it's abnormal. It's beyond what we expected. So we are saying these abnormal losses, how they happen is that if, let's say, we expected that we are going to be incurring a normal loss of let's say 10%, and our output is 10,000 units. If you are expecting a normal loss of 10,000 units, it means we are going to get 10% of 10,000, which will give us 1,000. That 1,000 will be our normal losses. But what happens is that when we compute the expected output, it will be the 10,000 as in our input minus the 1,000 that is the normal loss, which will give us 9,000 as our expected output. So we assume that when we put the 10,000 units in the process, we expect to get 9,000 units of output. But what happens is that if we put in the 10,000, instead of getting the 9,000, we get 8,000, which means the actual loss now will be the normal loss of 1,000, which reduced the input to 9,000, and also the 1,000 that reduced the expected output to the actual output of 1,000. So what happens is that when you're computing these normal losses, we either get it by getting our actual production minus, I'm saying actual production minus expected output. And to get our expected output is input minus the normal loss. So what happens is that if you find that the actual production is less than the expected output, there we are going to be having an abnormal loss. And the accounting treatment will be, if we have those abnormal losses, we are going to credit them to the process account first. When we credit them to the process account, then it means the corresponding entry will be debited in the abnormal loss account. But what happens is that at the end of the month, when we are closing off our books of account, we don't want to leave the other abnormal loss account unclosed. We transfer that cost to the profit and loss, because we are supposed to treat that abnormal losses, since we did not expect it in the production, and we did not cater for that when we are beginning or when we are planning our production. It means it's going to be treated as an operating expense or an operating loss. When we get that loss, it means we are going to transfer, by transferring from the abnormal loss account, the figure which is there, we make sure that we credit the abnormal loss account and we debit profit and loss account. Debiting profit and loss account, it means subtracting that figure from the gross profit. Hope you've got that. Then now we can try to go through into these notes, and we see how we can be able to understand more. Maybe to add on something, if let's say those abnormal losses we have, let's say they are in form of, they are not wastages, they are scrap values or they are scrap units, and they have a sellable value. if let's say you can sell them out, and whatever amount you get, it will now, when you multiply by what they are going to be giving you as in a unit cost or price, we shall be getting our sellable, the scrap value. When we get our scrap values, we are debiting the scrap value account and we are crediting the abnormal loss account. The reason why we are crediting this abnormal loss account is that we want to reduce the abnormal loss we incurred in its very own account. Because remember, when we incurred the abnormal loss, we said we are crediting the process account and we are debiting the abnormal loss account. So if we sell some of those goods, we just make sure that we credit it and we try to reduce that loss. Because you may find what happens is that you may find that those units you have not yet sold, you have not sold all of them. You may find that some particles you can't even sell them. And we are saying these abnormal losses, they come as a result of negligence or carelessness of the management or the people who are in charge. So if it is as a result of those people who are in charge and they can be controlled, it means we are supposed to treat those as operating expense. Hope you've got that. Then we can go through this small information we have. We are saying abnormal losses represent the loss in excess. It is in excess, meaning something above, it is over and above the normal losses. The other method you can use to determine the abnormal losses is getting the actual loss incurred minus the normal loss. And if you find that the actual loss is bigger than the normal loss, there we have an abnormal loss. The other alternative will be for the gain, as we are going to see it. So we can proceed, and we say that it's unexpected. Of course, we know that any loss is unexpected. We don't go in business willingly to make losses. They are all unexpected. They're unexpected and controllable losses. These are controlled, but they are not like the normal ones. These are controllable losses, which are not always provided for at the start of the process. When you are starting our process, we don't budget these abnormal losses because we assume that we are not going to incur them, because there is no business that can come in and you start the production with the intention of making losses. We just get what we can have as the normal losses, as the prudence concept says, that you remove what you were likely to face as in terms of the losses, not necessarily assuming that you are going to be making profit all the time. So we are saying that these are due to improper mixing of the ingredients. An example I can give you, if let's say someone was just making chapati and you find that instead of the person mixing salt, because one of the ingredients they put in chapati is salt, and you find that the person has put in too much salt. When you put in too much salt, it means you are going to scare out the customers, and at the end of the day, you remain with your chapati because they will not be eating them. So it is because of the improper mixing of the ingredients. When you mix those ingredients and they are not properly mixed, you find that you are going to create wastages. The other one, we have use of inferior materials. You buy, since you want to save costs, and you find that you've bought low quality materials, of which is going to cause you to buy more of the materials, and you get less of the output. Those are the things which are causing the deviations. Then the other one, we can talk about the incorrect cutting of, let's say, raw materials. You find that if, let's say, you are involved in carpentry workshops, because you know those guys, when they are doing their work, they keep measuring everything, and you find that you have measured, someone wanted 5 by, let's say 5 by 6, and you've cut it in a different form. Of course, you can't extend it because you have already cut it. So what you can only do is to sell whatever you, even if it is still good, but you can't make what the customer wants. Those are the losses, and they are due to negligence or the carelessness of the people who are responsible. So we said we are treating these as an operating loss, and they are debited to the profit and loss account. Debiting profit and loss account, we said we are treating them as expenses, or we are lessing them, and we'll create the abnormal account. These are the things we have just explained to you. We can go to the next video and watch how we can be able to get the abnormal gains and all of that. When you're done with this, I'm going to put a question, a practical question that is going to be combining the abnormal losses, abnormal gains, and the normal losses. So we shall be having only one question that will be having everything together, so that we can be able to appreciate what we've been discussing in the theoretical aspect. Thank you for watching. Until we meet again.